Thanks to Delupa for sponsoring this season of Compounders. Delupa scales the velocity of an investment team's idea generation by allowing analysts to spend less time locating and manually inputting meaningful disclosures into Excel. As someone who spends a lot of time updating models with data that some of the other major platforms, such as Bloomberg and Capital IQ, don't capture, I have seen firsthand how much time Delupa can save professional investors. Specifically, Delupa captures data from all company-reported sources, including from footnotes, MD&As, and investor presentations. Their data sheets also include GAAP to non-GAAP adjustments, guidance, and all company-specific KPIs. Each data point is auditable to the source for easy verification and accuracy. Delupa's Excel plugin can also update existing models for the latest quarter in just a single click. More bulge bracket banks and top-tier investment managers are trusting Delupa for assistance in initiating coverage, building and maintaining industry dashboards, and keeping models up to date. Please visit www.delupa.com/compounders to learn more about how Delupa can help increase your team's speed to differentiated insight. Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guest on the show today is Brandon Halcott, a true entrepreneur. Brandon founded a company called Tru Family Dental, which was a roll-up of dental practices that was sold to a private equity-owned dental company a few years ago. Now, Brandon is at it again, but this time is focused on building both a dental practice platform and one dedicated to engineering and architectural firms. In this fast-moving conversation, we discussed the journey that led to the founding of Tru Family Dental, the opportunity that still exists to consolidate dental practices, what he finds interesting about engineering and architectural firms, how Brandon has chosen to fund and finance these companies, and how his approach is a little different from that of a typical private equity firm. And without any further ado, here's my conversation with Brandon Halcott. There are a lot of places we could start this interview, but I thought it'd be interesting to hear about the journey that began with your graduation from Harvard Business School in 2010 and led to the co-founding of Tru Family Dental in 2013.
Absolutely. Great place to start, Ben. Excited to start there. I say that I went to Harvard because they admitted me, and then they need to let a farmer in per year, and I was the only one to apply that year, so got lucky in terms of all that. But I used business school as a way to kind of reset the career path, if you would. Up until then, had been on a financier career path, so did investment banking out of undergrad and private equity thereafter. It wasn't because there was a passion for that. It was I grew up in a really small town, and anyone who was successful was a doctor or a lawyer. And so showed up at University of Chicago and started down, sat in Gen Chem and got my doors blown off. So I was like, okay, I can't be a doctor. Didn't know about the lawyer, and so went into econ as a major at University of Chicago. They had a really good program there, and learned about investment banking. It was a really hard job to get, paid well, work really long and tough. And it's like, oh, that all sounds great to me. Like that seems to fit really well. And so started there and then went into private equity. But I never could get a 3-statement model to balance. So at some point I realized that, hey, this isn't the path for me. But I really enjoyed and always had a great rapport with management teams. And so I used business school as a way to reset the trajectory and become more entrepreneurial. Like that was my application. Because I just saw the businesses that we sold or raised financing for as an investment banker or owned at the private equity firm. And it was really clear, wow, they're having a ton of fun. Does what they're doing on a daily basis match up with what I think I'd be great at? And because I think that's a fun part of life. For some people, it happens earlier, for others later. But what are you great at? Like, what can you wake up and do? And it just brings you joy. And so that it's not a 4-letter word, work. It's I'm living and I'm doing what I'm great at. And that business school was the start of that, to try to change where I was headed and what I was doing. And Harvard's an incredible institution and incredible brand. And I mean, the education was great, but more importantly, like the people that I got to spend time with, and the 90 people that were in my section the first year, just got to be able to learn from them and understand and see so many different world perspectives, because people were international, professional perspectives, because everyone came from different walks of life. So it truly was a phenomenal experience, and I mean, wouldn't change it, wouldn't go back. And some people have their druthers on, does an MBA drive value? And I mean, for me, I absolutely say that it does. You're really able to raise your floor. America is always a meritocracy, but if you've got that piece of paper, you can if you're going to go swing big and fail, you can fail softer, I guess, or easier, more gentle landing if you do fail.
And it took you a few years before you landed on Tru Family Dental as your focus. Maybe you can talk a little bit about the other things that you worked on and tried before you got there, and then what you learned in that process.
Yeah, so out of school, I wasn't I wanted to be an entrepreneur, but I just didn't have, like, hey, what am I going to do? Like, what I've learned since then is I'm bad with a blank sheet of paper, but I'm really good with a painting that needs to be painted better. And like, if you give me something that's going like, oh, great, boom, boom, boom. And so it's just that initial creation that kind of causes me causes me to stall, so to speak. But out of school, so I wasn't ready to go do something on my own. And my thought was, hey, I'm going to go work for I'll go work for a CEO and really learn what it takes to be. So I did that for a little bit, and it became apparent to me that you were responsible for your own education. Like, someone else isn't going to deliver that, and you're you're helping them be better. But you're, at the end of the day, if like it's always a school of hard knocks. If you're going to go out and build something, try something, etc. If you're doing it on your own, that's where you're really going to get a lot of value. So I did that initially, and then I went and started a car repair company similar to Safelite, who's doing windshield repairs. We were doing cosmetic repairs, which is a pretty big industry, $9 billion industry, very fragmented, a lot of mom and pop shops out there. And so the thought was to use tech to deliver the B2C. So if a consumer has a dent or scratch, is the dent bigger or smaller than a dollar bill? And then is the scratch to the metal or not? And for both of those, and I can't control these balloons. I don't know. They've been happening to me on Zoom from time to time. So I apologize, but hey, we're celebrating today. I don't know if it's your birthday or not, but I might be early or might be late. So the car repair business was, it was that first for like my first time going and putting something together and really trying things there. And the mobile application was incredible because we could source consumers cheaply, and we were buying keywords because other people weren't buying, like body shops weren't buying keywords at that time from like a PPC perspective. And so you could buy the keywords, and we were going to give them an instant estimate. We're going to do the work at their home or office. So the friction that exists in the industry is you go to the body shop, you're ignorant in terms of, like, you don't know what things cost. There's not like and you feel that you're going to be taken advantage of, and so we were trying to remove all that, being transparent pricing, those type of things, and working well with insurance carriers. So that was the consumer side. And then the B2B side, we were using enterprise at airports. We were working on their cars and helping them lower their turnback time. So a turnback time is, you get a car, it needs some work to be done. It either has to be cleaned, washed, vacuumed, etc., or some work might have to be done on it. And your inventory, as your turnback time gets longer, your inventory is going to get bigger because you need more cars, because less of the time they're outside of the available inventory to go to customers. And so we were taking them and turning them back in 2 to 3 days with these small dents or scratches that normally took over a week at the body shop. So then they'd lower their inventory needs on a given location, and we would expand geographically with them. And it was, I mean, just, it was working really well. my investors, so there was major investors that existed there, lead investors, if you would, but all private capital, no funds or VC funds, things of that nature. And there was concern around dilution and growing big and taking on big equity rounds. So it made sense to me that, hey, the growth was going to be challenging. So I sold my shares and then went to a roll up of for-profit beauty schools. And I mean, and then especially next, since dental comes next, the question is like, how does this all fit together? Well, which is a great question, because there's like, what's the commonality? On the surface level, there is none. But if you dig deeper, they're fragmented industries that had low technology adoption. So back to that, give me a painting, I can paint it and make it better, but give me the blank sheet of canvas, and that's where I'm going to get scared. And so did a roll up with for-profit beauty schools, who was out buying locations, putting them under one brand, adding additional technology from not only the student acquisition piece, but also the curriculum within the individual schools, and had a lot of fun there, learned a lot. Unfortunately, we were running into Title IV funding from the government. So the funding for your HVAC majors, your beautician, those type of things was running out. And the industry changed like overnight, unfortunately. And so I set sail again for next adventure, which became Tru Family Dental.
This season of Compounders is sponsored by Dilupa. Dilupa was founded by a former hedge fund analyst to bring simplicity to the investment process. Dilupa offers an AI-driven single source for all company-reported data and allows for investment teams to make the most informed decisions in the shortest amount of time. For more information, please visit dilupa.com/compounders.
And before you started thinking about the dental space and the opportunity there, did you know anything about the industry, or did you come into it cold and try to apply some of the fragmented industry lessons that you learned from the prior ventures?
It was a little bit of both. So at the private equity fund that I worked at, we had a roll up of physical therapy practices. And so that was ATI Physical Therapy, which still exists today. Large business. Advent took them public a few years ago. And so, I mean, that thing has done incredibly well. But yeah, I'd seen that part. And that's, if you look at the spectrum in like healthcare or multi-unit outpatient healthcare, if you go from physical therapy all the way up to your outpatient heart, like you're not going to do outpatient heart surgery, but the heart surgeon would be up here in terms of very specific focus. And those are there's few of those, whereas physical therapy, you're not repeat customers, but you've got this flow of customers coming from all the surgeries being done, or injuries, work comp claims, things of that nature. And your specialization of the provider is less specialized here versus a heart surgeon. And so what I learned while we were doing that is, as you move up market in terms of the specialization of the provider, there's more key provider risk. Like if the replaceability of that, and not like how hard is it to hire someone else, and how many of those individuals are graduating on a given year, and then what's the demand side. So learned a lot about that. Obviously, it was totally focused on the physical therapy side, and so knew about roll-ups, healthcare, those type of things, but dental specific, I had to learn everything there. But the fragmentation that existed and the low technology adoption were there in droves. Like in 2014, when we got started, there was still a decent amount of offices that had paper charts. Like, so you're, wow. And what happens if I want to see how many procedures I perform? Well, you have to go pull charts and count. So it was pretty clear that, and that was throughout the entire industry. So you could see the opportunity that existed there.
And we're going to talk a little bit about technology within the dental space in a couple minutes, but I'd love to stick on the diligence side. So there's some pattern recognition here. That you saw that there was some similarities between what happened at your private equity experience. What kind of diligence did you do to be comfortable saying that this is going to be my next big swing, versus all the other things that you could have done?
Yeah, and so the three choices at the end were self-storage, fleet refueling, and dental. And the all fragmented, all low technology adoption. I think self-storage is done really well as you look at that through the period of time, and then fleet refueling. You're going around filling up delivery vehicles because anyone that has like that type of or even construction vehicles, like you can't take the tower crane that's on the construction site and take it over to 7-Eleven and gas it up, right? You gotta so you have to do these things on site. And any of those businesses that have that as a P&L line item, there's a considerable amount of shrink that happens. So because you'll have, filling up personal vehicles with some of the diesel that's on site and things of that nature. So you would, that technology there was barcoding each of the individual assets and then looking at consumption and sharing that data with the customers. And then all of a sudden, like, wait, why is Brandon consuming so much over here on his truck, and Ben is only consuming half as much? Well, Brandon's filling up his personal vehicle. So all those were the three opportunities. The self-storage and the fleet refueling, they were going to take a lot of capital to get started. Like no one's going to finance your line to go buy diesel fuel because it can easily walk away. So I was struggling with raising capital, like diluting myself to be used for working capital. It just seemed like an inefficient use of equity. And but you needed to do that because you weren't going to be able to debt finance that. And self-storage, similar thing. Like I would have to go raise a bunch of money to be able to start buy number one and keep it going there. Whereas dental, banks were very comfortable lending. So that was one lens that was used. And the other was, I mean, what I liked was the barriers. So if you're going to go buy Dunkin' Donuts, you're approved as a franchisee and then you're off to the races. In dental, there was all these complexities that existed and that I knew about from my time with ATI in terms of who owns the professional corporation that's providing the services to patient and is contracting with the payers, which would be like the insurance carriers that are reimbursing for procedures done, and then who owns the management company. And there's a legal structure called a friendly PC that's able to do that. It just dawned on me, like, these are complexities that exist that are going to prevent mass entry into this type of it's going to create barriers. And in 14, my partner and I were fairly early on into the DSO game, whereas now there are hundreds of private equity backed platforms that are out there. But at that point in time, it was still pretty small. So it was fun to be early to the party and see all the other guests show up, which was serendipitous. But at that point, hey, diligence wise, you looked at how fragmented it was, and it was maybe 5%, maybe 10% consolidated. So you had a huge runway in terms of what you could go do.
And you talk about your core skill set being taking a painting that's already, half painted or somewhat painted and making it better. I'm interested, as you were assessing the opportunity to create a platform that included a number of dental practices, where did you see that there was room to help the individual practices be more efficient or profitable?
Yeah, and there's a lot of opportunities. And it goes back to the paper charts in 2014. Like, wow. But with the opportunity, there's the reason that we could go do what we did and still can continue to do that. There's some like macro factors that were taking place within dental. So the cost of education had risen considerably. Historically, the model was always apprentice. You graduated, you went and worked for someone, and then over time you bought their practice. Or they sold it to you. It was that the apprentice model worked for the transition of practices from legacy providers to the new crop of graduates. And that tuition all of a sudden being $400,000, $500,000, that was creating this debt burden and graduates looking to receive income so that they could pay down the debt versus trying to go back out and swing again and try to not swing again, swing for the first time and build something on their own. That's number one. Number two, and I'd say these are probably all even in terms of their impact on the industry. Number two was the fact that millennials, like, there's a little bit of a different mentality in terms of the staunch desire to be independent, hang your own shingle, and go out on your own. Community more important, being part of something bigger. that support, and maybe not I don't know if it's the entrepreneurial gene, but it's just, hey, when I look at what I want, the quality of life that I want to lead and what's required to run my own practice, I probably would rather have the great majority would rather have that help and assistance and not go hang their own shingle. And then the third element was female graduates from dental school was now the majority. And that desire was to continue to have a six-figure income and be able to practice what they learned, but do that 2 to 3 days a week. And so they can still spend time at home with the family, but not have the work 4 days a week chairside, and then Friday and Saturday do supply ordering and payroll and these other things. So it was this combination of those three that were creating this opportunity for consolidators to exist, because previously the practice would be turned over to that new grad through the apprentice model. And so that's the backdrop that allowed us to enter. And then on top of that, at dental school, I think there's a couple hours of business training. And then after that, it's all on the job. And there's a lot of consultants that are out there to help individual practitioners. And look, it's an incredibly profitable enterprise if it's well run. You can, I mean, after if you pay yourself a market salary, you can still have 30% profitability left over in an individual location. And that's awesome. And you paid yourself market, and you can still walk away with that much. And that's if it's well run. But what we looked at is your P&L is predominantly dominated by labor. So clinical labor, your dentist, and then non-clinical labor, including hygiene, front desk, and other dental assistant and other team members within the practice. So that's, your mid 40% range. But where we focused was you can focus on the cost side or you can raise revenue. And so we tried to do both at the same time, because then you had obviously margin expansion. And so as I was going down the cost side, so labor, big component there, but we're not in the business of going and buying something and then trying to cut labor. Like that's not a good story for anyone. Because it's a small industry. And when you buy an office, that's going to be a recommendation for the next seller. And those team members are going to be recommendations for the next team members that you buy. Because every time you buy an office, like Ben decided to go work at this practice. He didn't decide to go work for the Tru Family Dental brand that came in and bought the practice. So you got to deal with that. So the labor piece, we weren't trying to cut there. But then once you go from that, there's labs and supplies are the next big pieces. So your labs are the crown products or other, maybe dentures, could be removable orthodontic products, Invisalign, Smile Direct Club, those type of things that are going in. And we would just call the manufacturers or the distributors and, hey, we're building a business here. We want, as we continue to consolidate, we need some scale here. And so would work on that purchasing power and also try to tighten what we were buying. Because if you can guarantee spend across specific categories versus being scattershot, like long tail-esque, they can do a better job of inventory management, and they can go back to manufacturers and bring better discounts to us. And what we did there is had our once we got to the size, that we had a clinical team that created a formulary that was, hey, we've got choice within these buckets, and our providers can choose up to 3 or 4 different things that exist there, but we've consolidated it so we're not buying 50 different items for 50 different SKUs for one item. Like, let's say like the piece of gauze that's used, like here's the 3 options of the gauze, or probably even less than that, because no one ever had a lot of opinions on the gauze that was being used. But so that's how we focused on the cost side. There was really like looking at contracts, negotiating, taking advantage of economies of scale, better inventory management, making sure we weren't ordering if we didn't need, just because we ordered every month, making sure that we actually needed that. And then on the revenue side, so it was, we would convert all the practices to one software that we use, which was our practice management system, which then unlocked the data. And the data could be, Ben was in last month and he hasn't been in, and he did not make an appointment for 5 months from now for his recare appointment, right? You're supposed to come twice a year. And so just looking at what patients left today without a recare appointment and driving that number down, looking at what patients have outstanding treatment plans like that we've diagnosed, and making sure that we understand that when they're back in the morning. So they're, operationally is where we got very, very involved, and we created my partner and I, we both sat at a front desk for 6 months early on, because we approached it as private equity guys out of the gate. Oh, we're going to buy some of these things at 2 times EBITDA, and then we're going to sell at 10, and we're going to be brilliant businessmen. Well, we bought some stuff at 2 to 3 times, and it underperformed. So like we didn't factor that part into our 2 to 10 time arbitrage opportunity. And so we got to go in and run these things to create performance, to create cash flow that allowed us to continue to receive debt. And yeah, I sat there for 6 months, checked patients in, verified insurance, checked them out, did everything, and really wrote a manual called the Tru Way, which was like 300 pages, that showed how to use our software within the practice. And those were our like operating principles. And I mean, we were able to drive EBITDA after ownership, 30 some percent year one, and revenue grew at a similar amount. And so we were actually less, because we had the expansion from the control on the cost side. So, mid-20s revenue growth from every one of our offices that we bought. And like that was how we did it, both top line focus and bottom line. And it was regimented KPIs and using the data to drive decisions, and then making sure to have like the culture of excellence. Like there's a distinct link between oral health and overall health. And if we're delivering someone optimal oral health, they're going to be a healthier overall. And that was our mandate, and what we existed to do and existed to perform. And if you're giving someone clear care from an oral perspective, you knew the benefits that existed there.
I love that you sat at a desk for 6 months. It's the ultimate example of things that are not scalable, but highly important in terms of your learnings, right?
Well, it's like humbling too, because you spend we spent 9 months trying to buy a practice, and the first practice we bought was from a dead guy. That's the only person that would sell to us. Obviously, they didn't have a lot of choice, which, I mean, like so you're like, it's humbling to have that. And then, by this point, a couple of years out of school, and like, wait, I got this great shiny Harvard MBA, and here I am sitting at the front of a dental practice for 6 months. But I mean, that was like the Tru Way. And then because if we understood the business at a granular level, we could see the opportunity. And yeah, like I've always been, and I don't know where it comes from, but when someone tells me no, that's like, oh, this is where I should spend my time. And it could be like, I struggle with no turn on red, because like the government doesn't trust me to turn on red because I'm gonna get hit by a car. And I struggle there because like I look right, we'll probably look left first, right? I'm turning right. And then I look right and no one's coming and I can't turn. I struggle there. And so all the time when someone tells me no, as I'm like, oh, well, that's my opportunity, because like it's that viewing that painting in a different light or with a different lens. If when I'm looking at it now, well, why this makes total sense to me. Why aren't we doing this? Well, we just never have, or the industry doesn't believe that way, or we've always done it this way. Well, awesome. That's perfect. Great opportunity. Let's go. And change is hard. Behavioral change for individuals is hard, and really learn that because like if you look at Bezos and Amazon, hey, I'm going to turn up the widget machine to move more boxes. Like it doesn't work that way in a service industry. And that was also something that was great about dental, that I knew we couldn't get attacked from big tech. But like what makes humans great, like you chose that plant and that poster. I chose these books. Like we're all human. That's what makes life beautiful. But then if we weren't and we were all robots, it'd be the same. But now we're in it's really hard to understand what Ben wants and what he wants to achieve. And it's different from this person. And in every practice, there's 15 people, and getting them aligned to have patient care It's daunting, but yeah, the ability to, hey, we've done it, to rest on one's laurels like doesn't exist, and then also just to, I'm have forgiveness, not permission individual, and I think that's probably a trait that exists in a lot of entrepreneurs, because you're going to go do so. I mean, at the end of the day, so many businesses fail, and you're literally going to go do something that you've got a probability that isn't favorable, and you're crazy or dumb enough or naive enough or maybe hubris to believe that you can go succeed. So those are all pieces. But yeah, that's how that 6 months was humbling. But the true way then became like, it was, you'd go by an office and you could go down and look at everything that we would want to do like, this is perfect, and you'd compare it to what exists, and then you'd map out by week in terms of what would spend time training on, and then you'd go back and look at the data after you've trained on it to see if it was done, and the performance would take off. Because if every patient leaves with a recare appointment, you're going to have more patients. And if you're doing a confirmation call and you're having a morning huddle in the morning reviewing what you could do that day, life's like, it works. And so it's simple, but yet so complex because of the nature of humans.
I want to jump back into the technology question or discussion that we kind of touched on earlier. So I used to be a shareholder of Henry Schein, which is the largest dental supplier in the world. And the management team there always talked about how hard it was to get certain dentists to embrace the technology. Maybe talk a little bit about your sense of the importance of technology when it comes to modern dental practices, and how you thought about using technology to make the practices more efficient and more profitable.
Yeah, I would totally concur and agree with the management team there. Like, I wouldn't wish a dental practice software conversion on my worst enemy because of how painful and hard it is. It's hard, and so like that's what we were up against. And so we had to sell what the product could do different than what was existing previously. And the question, the concerns or the friction that would exist. Oh, our UX, like the user experience, this is how we used to enter this, and it was so much easier. Like, that's a small piece of the greater mission of what we're looking to do here. That was a non-negotiable for us, and we knew that that was a challenge. But we just started with that, and so we knew that we were going to have the same software, and we were going to have the same AR, and everything was going to be managed the same throughout the entire organization. But then beyond that, every like it was very hard to change. But what software allows you to do, and what we were really trying to utilize it for, and I know we're going to get to it, but we're going to go build another one of these. And what we didn't focus on as much because we were non-clinicians, we focused more on the cost side. But as we think about it this time, iteration 2.0, what software can allow you to do is, if you're freeing up FTEs or an expense that you would have had in the organization, that you can reallocate that on the customer facing side. So if everything that we do helps us get someone to optimal oral health, and software helps you get there, like that's the beauty of software. And look, I mean, the proliferation, the pandemic helped out in terms of all of a sudden you're doing some teledentistry or things remote and trying to confirm a point. Like, the pandemic really allowed more software to come in and people to be more open to it. It's still there's still friction that exists, but more people at this point in time, we started it, we were 10 years almost from the time when we started. So you've had 10 years of retirement and 10 years of new entry, and the generation that's coming in, right? They've never lived without one of these devices in their hands. Like, that's always been. And so the consumption of technology and other things, and quite frankly, like the products that exist to help practices across many different areas. So accounts receivable, accounts payable, driving revenue, confirmations, all different facets within the practice have come to the forefront. But that back to it, it still continues to be a change, and changes are tough for human beings, and especially with new tech that you've got to really you can't use a shoehorn. It's got to be soft.
And you mentioned that customer first mentality, and that's something I've heard you talk about in other interviews. I think most people don't think of the service they receive at a dental office the same way they receive service at a restaurant or hotel, but the customer experience still really matters. Did you have any big insights or learnings when it came to the service aspect?
Yeah, I think that like why shouldn't we think of it that way? And historically it hasn't. We had a board member that said, when you're in your offices, look up. It's like, where do all of your customers look the entire time they're in there? You know, and so because then you see some cobwebs or a stained tile. Most of the time you're looking on, and so that was a great perspective for us to then open up this whole other like avenue, but just always to constantly think about the customer. And I've mentioned Amazon in terms of ability to move widgets, but they do a great job with internally when they're at headquarters. There's a chair in every meeting that's empty, and that represents the customer, because when you're in the office and you're not out there as a customer, you can lose face and be like, wow, if we do this widget on the website, or we change this for shipping, like that's going to make us a lot better, maybe make my job better on accounting, who knows what but the perspective is the lens that they see that's really close to them, which is their lens versus the lens of the customer. And so we tried to do the same. Any decision or anything we were trying to push into the practice, it could be a new financing option or a new credit card processing, storing your credit card on file. Like, we would always have to ask ourselves, hey, how does this change? What does this do to the customer? And on that service piece, people don't, they might not expect it to be like the restaurant, but when you have a great experience anywhere in life, you're a promoter. And the health of a dental practice is driven by how many active patients they have. And your active patient count will absolutely increase if people are having a phenomenal experience and they're promoting your business. Because it doesn't need to be like, it gets really hard for someone to switch a dentist, because you know where to park, you know where to go, you've been there before, you're comfortable, and you already created this rapport. But if that does happen, people are going to they're going to go to the internet, but they're also going to talk to other people. And we just wanted it to, no one says today's going to be a great day. Like, Ben wakes up in the morning and says, I got my dental appointment today. It's going to be awesome. It's going to be a great day. No one ever says that, but that was our aspiration, to create that experience where it was, that people were like, you know what? Like, I've been informed so much and I understand so well about my oral health that I'm glad I'm going there today. Maybe I'm not excited, but I'm glad I'm going there. And this is a great place that takes care of me. Like, at the end of the day, I mean, what more could you want to be part of an organization that delivered that type of experience?
And you went through a private equity roll-up of the physical therapy space when you're at your previous firm. Is there anything you chose specifically not to do that is typical of private equity roll-ups? I'm thinking, it sounds like the customer, kind of customer first focus versus profitability focus. Anything else that, like, maybe you took away from that experience and said, I want to do this a little differently when I have my hands on the wheel?
I mean, broadly speaking, no, but given that my hands were on the wheel, I mean, it was a representation of me as an individual and my partner. And we cared deeply about just, I guess, not only the customer experience, but also the team member experience. Like employee was a banned word. There's like, we're not employing you. We're on a team together. So you're a team member. And like we had we called it our support center. That was the corporate office, but the support center, because we were supporting the practices. we didn't get to touch patients there, but we got to support the team members that did. And we shared, we didn't share an office, but we shared a wall, my partner and I, and they were the smallest offices of any of the executive team. And that was by design. Like we're no different. We do everything the same. And we would have team member parties, and we would be cooking the entire time, serving, because this is our chance to thank everyone. So I think it was things like that. But I mean, at the end of the day, like private equity fund's going to use leverage. We use leverage. They're going to grow through organic growth and M&A growth. Did both of those. I mean, I know that at one point in time there was the cost-cutting side of buying something, stripping out costs, increasing profitability. But I mean, some of that still happens, but like I don't think that's the predominant go-to-market strategy. The difference is that like it was our capital and we had those experiences, but we were deploying it as operators, which was a very different thing. Like now I know when sitting in the ivory tower with an Excel file of growth and a hockey stick, and then handing that to the operator, like how disingenuous that was, because actually having to achieve what's in the Excel is a heck of a lot different than putting the Excel model together. So it became an operator and took lumps, grew a lot, but had a heck of a good time.
And Tru Family was sold to Heartland Dental, a large dental service organization that's owned by KKR, in late 2020. Maybe you can talk about the impetus for making that transaction.
Yeah, we weren't for sale, and we'd always thought we built the business. We had a full, really great F&A team and things, like, meaning we were building it for a sale to a sponsor or to a private equity fund in our mind. And we would run it for a little bit and either keep running it or that decide that they wanted to go a different direction. But we thought that was the plan. And the COVID happened, and Heartland they weren't able to do some single shingle type transactions because no one knew what was going to happen. And the standalone providers were still trying to get back on their feet. And we had a great relationship with them. Like they were instrumental in terms of early on providing support. And that's one thing that the dental industry is very open in terms of sharing. There's some stuff that's kept close, but I mean, everyone's approachable because everyone wants success. Like everyone wants the patient to be treated well. Everyone wants the organizations to succeed because it's better for the industry, and it was growing pretty quickly. And so we had a really good relationship with the management team, and once they'd been phenomenal. So we had this relationship and started talking about doing something, and obviously it came to fruition. But we didn't have a banker, we didn't have a process. This all came about very naturally based on relationships, and kudos to them for helping us out, because it ultimately worked in them being able to acquire what we think was a great business, and what I hope that they feel was a great business, because they had put in the work earlier and formed that relationship. And it goes back to customer service or promoter. Like we're obviously a huge promoter of them, and that resulted in an acquisition, like a sizable acquisition for them.
And you hinted at the fact that you're at it again in the dental space,
Yeah.
Along with another venture. But let's start with Seva Dental. Talk about the strategy there. What's anything different? How are you approaching it this time?
Yeah, what's incredible is you can, like, if you've played the game before, when you go to do it again, your muscle memory is obviously there, but then you're also expanding your vision so much farther, because you're like, all right, I already know this part, and I've seen that, and I've played that part, and I'm very comfortable there. Like that's on autopilot, so to speak. And you've got that really, but now, hey, it's just really fun starting from zero again. And what do we want to be? What's our true north? And how do we align everything towards that? And how do we create incentives, comp structure, all these pieces before that we had no idea. Like ignorance was bliss. Whereas, and we would build the plane was flying and we were building it. Whereas now we're going to be able to set some really great things in place before we get started. And so, but very similar in terms of buying offices and improving performance through operations and efficiencies, technology, those type of things. But really excited to, you won't make new mistakes, but these other ones that we've already made are pretty exciting. And I was like going through a file of, okay, here's the stuff that we want to do before we buy our first practice. And you looked at like what that volume of work was historically and the number of years and the ability to like get that up and going out of the gate was like, oh wow, this is going to be much different this time.
And I'd love to dig in a little bit there. Any anecdotes or stories? Like what mistakes are you definitely not going to make again?
Oh geez. So I guess like our first office, we just bought something to buy something. And now that office turned out to be a tremendous success, but the need to just get something won't, like, time is a precious resource, but we're not going to do something that we know that can't be successful. I think making the customer, like, obviously going to be focused on the cost side, but create more of a culture around the customers, the patient side. Because at the end of the day, if you're serving the patient, and everything else from a financial perspective will make sense. Like any water that rises, it's going to hide a lot of rocks. And so that's a much, in theory, easier way to increase financial performance. I don't think we'll be as I think more create a better, not a better, but create a tightly wound relationship with our doctors, in terms of, hey, this is creating opportunities financially for them out of the gate. But like some great mistakes. There was like we were buying an office, and the wire was in process, and I go to the practice front desk, like, hey Brandon, how are you? Good. Well, who's working here tomorrow? I'm like, well, you're here right now. No, I quit with the rest of the team. So the seller hadn't told us that happened. Another time we bought an office that the majority, well, all of the revenue was done by a dentist who had left a couple weeks earlier. So we didn't think to like look at a revenue by provider mix and be like, well, where's that provider? Because there was a provider there, but it wasn't the provider that had done all this great work. Our most challenging deal, we didn't understand there's different type of practice philosophies. So you can the episodic is a meaning a patient comes in pain and you get them out of pain. And so it's like emergency type service. And we bought an episodic office not knowing that we bought that. And the way you can tell that is you can just see like how many patients are coming in for their hygiene, like their preventative stuff. And at that point, we weren't understanding the link between that preventative piece and the philosophy of the office. So like that was our most challenging deal, and which was great. It was a black eye, and we learned. We got it to a point of okay in terms of where it was at, but we took a lump there, and now we got that lesson on the type of care. So those are just a couple of the examples, but the not understanding who did the revenue, like, and then you close and you're like, wow, this office is really great, and then you see like revenue not being at the same, and you're like, what's going on? They're like, well, that was a different provider that's not here, and it hadn't even dawned on us to figure that out before. So our those are we always talked about, you can break any bone and a lot of lacerations, you can't bleed out, so don't lose an appendage. But we made a lot. Those are some of the mistakes, and there are many more.
Those are great stories. Thank you for sharing. And so you have a second venture, which is focused on architectural and engineering firms. How did you land on that space as one to focus on?
My partner from dental, he had previously worked at a private equity fund that had bought a project management business within the A&E industry, and that business has done incredibly well. The CEO and my partner remained friends, and the three of us got together about a year ago and decided it, because had always been, my partner and this gentleman had always been talking about opportunities. And as they kept talking around architecture and engineering, it became clear that there's a lot of similarities that exist to doing a roll up there that existed for us in dental. And then Finley, our partner, he's got the domain expertise. So it made a lot of sense to put that together. Now, in each of these, in both Seva and Providus, not going to be operating this time, but not going to be a board member only, where hey, we'll see every quarter. What we view it as is we've got this expertise that allows a company to scale quickly, and it's our responsibility to work on the business while a management team is working in the business. And so if you've got, like, in the dental business, like right now, earlier today, I was on with some HR, like some human capital management software vendors. So I'm going to go get that set up and then launch that. And obviously our CEO will be responsible for it, and he's being involved in picking it, but I'm doing the legwork of the research, the meetings, and seeing the pluses and minuses, and we'll make a decision together collectively. But we were like, my partner and I sometimes refer to it as chair one. So chair one, you're responsible for everything, and I've also called it like toilet paper responsibility, because at the end of the day, when we were running the dental business, if an office ran out of toilet paper, there could be a call that was coming. Hey, why don't I have? And so, like, that's, if you're running something, I mean, it's a huge commitment. And I got 4 young kids, 6, 4, 2, and 10 months. So there's a lot going on there, and want to be active, want to keep building, and just think that right now, like, this type of style of continuing to build, continuing to grow businesses works really well for where I'm at, and I can continue to hopefully, keep the professional ball in the air and keep the family ball in the air, and kind of have it both. Because before, and that's also, I mean, I think Tru Family was the first big venture, and had other ventures, but didn't have the big success that we had with Tru. I mean, failure is not an option, and like, that's all that. So I was, there were no boundaries. I was going to say limited, but I didn't want to be. I wanted to be honest. So there were no boundaries. So if a dentist wanted to meet anytime, anywhere, any planet, I was going to make that happen, and we were going to build this business and crank it to make it successful. Whereas now, my plan is to have better boundaries. I'm at least conscious of them. I've learned that I'm a very black or white person. It's not like we're going to go do something gray. We're either going to do it or we're not. And so this will be a challenge, but one that I'm obviously, my wife and I agreed that we should keep going, or go back at it. So look forward to hopefully finding success in terms of staying true to the belief that I can have better guardrails, better balance.
This season of Compounders is sponsored by Dilupa. Dilupa was founded by a former hedge fund analyst to bring simplicity to the investment process. Dilupa offers an AI-driven single source for all company reported data and allows for investment teams to make the most informed decisions in the shortest amount of time. For more information, please visit dilupa.com/compounders.
I think people will be interested in how you're structuring these ventures. Do you have a fund? Are you a so-called independent sponsor, or are these more like holding companies? Maybe describe the funding structure a little bit for us.
Yeah, we've referred to ourselves as a little bit of a search fund, a little bit of a fundless sponsor, and a little bit of a private equity fund, because we're since we were gonna work on the business and help operate, it kind of moves us out of certain places and more to the search fund. And then from a capital perspective, we raised money from like other entrepreneurial individuals like ourselves or prior investors that came along at Tru Family Dental for Providus. And then with Seva, we're just using our own balance sheet there to stand that up and go build something there. So a little bit of both, and it's hard to, like, when people ask, well, what are you? And we go through, well, the search fund, the sponsor, independent sponsor, and then the actual sponsor. And they're like, yeah, you're probably right. Like you don't fit into any of those buckets.
I hear that, and institutions have trouble with that kind of nebulousness.
Yes, like when you're going out and you're like, because if people fit in box, life is easier if you fit in a box, right? Like I can put you there, I understand this, and so it's something new. But we've had success so far from a fundraise perspective.
And the one thing that's different between now and when you were building Tru Family is that the interest rate environment is totally different. So I'm interested in understanding if the recent increase in interest rates changes how willing you are to use debt to finance these deals and these roll-ups.
Yeah, I mean, it's obviously we're saying that, hey, rates are. I mean, you hope that they get better. You don't know that. So how we're modeling things is saying this is the rate. So it's going to impact returns and it's going to impact what you're able to pay. If people are more interested in a seller note with something that's comparable to what they're getting in a money market and other things like that, that can help out. It obviously could pay a little more in that instance, but yeah, I think that on the dental side, I mentioned hundreds of private equity backed platforms. LPs were asking funds if they didn't have a dental platform. Hey, why don't you? There's been the people have had success, and you had a large influx of supply capital, and then a lot of people started building things. And there are opportunities out there right now that aren't. They're doing okay, but they're just not performing like at a level that's going to like get the fund to be excited to put more capital in to get to that next hurdle. And so they're kind of, it's that in between state where like, well, are we going to sell this? We don't have something that's high performing. It's good. And I share that because of that, there's a little in some of our markets, what we've seen already is we've gone back and talked to brokers. There's a little less demand from a perspective of DSOs buying in the marketplace. So that's going to be helpful in terms of, all right, if you don't have competition, you're going to be, your valuation is going to go down a little bit. And so can that valuation decrease be offset by the increase that we're going to spend on the capital stack? And, but there's still the arbitrage still exists. It's compressed. Like people are expecting more for the individual practice to be paid. And the hiccups that other DSOs have dropped multiples on the platforms a little bit, and plus, like, look, what people are able to pay is inhibited by the interest rate environment that you mentioned. So, but there's still ample opportunity from an arbitrage perspective and to buy and create and to grow. But that's how we're being flexible, and then we're making sure that any capital sources that we have, that there's like no prepayment penalties and things of that in case we want to try to work our way out of something if rates do change here for the better in the next 2 to 4 years.
Is there anything different in terms of the way you're thinking about a potential exit when it comes to Seva Dental and Providus Capital Partners? Is it, you said you weren't for sale per se at Tru Dental, but there was always this kind of plan to consider an exit. How are you thinking about that this time around?
On Providus, that's a traditional hold period, but we've got flexibility in our capital that we don't have to. There's a close friend is AJ Wasserstein, and he's written extensively about the issues of selling something with the your capital's on the sideline, you have taxes, and if you've already created the flywheel, like why not just take advantage of that and use recaps as a way to deliver returns? But I in talking to our investor base, they're comfortable. Like our goal is that traditional 5-year type period. But look, if we've got opportunity and we see I view it very similar at Tru. Like we weren't there, but we had an opportunity to create meaningful shareholder value, and that when that's available, you need to take advantage of it. And so but the plan with Providence is a traditional hold period, but we don't have a requirement. There's not mandates in the docs to have it for X period of time, like LPs might with a traditional sponsor. And then with Seva, very much more comfortable there on forever, because it's our balance sheet that we're building it. And the last, we think we've got a great team to go at this problem again, and think that we can do a lot more, but would want to take time to really see that through. But once again, if we're in a market that someone wants access to and shareholder value is created at like incredible shareholder value, no one's ever gone broke by selling, so you may have missed the top, but no one's ever had those druthers after selling.
And being involved with 2 new ventures sounds like a lot for anyone. How are you allocating your time between them?
It's as I mentioned, like not being responsible for the chair side, or like being chair one and having everything flow up, like that helps out a lot, because the variances aren't like the blowups that happen get handled by other individuals, and there's always going to be that. Like there's all these problems every day that exist in a business, but I'm able to think strategically and work on projects to help them. Yeah, I mean, there's always balance and there's always prioritization. And I think that as I've continued to mature, I've gotten better at that. Always can get better, but yeah, the getting things done, GTD, David Allen, is a methodology that I practice in terms of trying to really plan out projects and then execute. So over planning and then execute thereafter, and managing my energy across different platforms. Like it could be work in the office, it could be work while on a plane, and just really trying to prioritize what work gets done and where. I think I've gotten better at that over time.
And you have to change your investing approach a little bit if you're not going to be an operator. I mean, I could see a situation in which you'd be very comfortable with a big turnaround and struggling office that you feel like, used to be able to parachute in and you kind of whatever, fix it, versus being more of a player coach and trying to coach people to be better. Is the kind of practices you're going to be focused on at Seva different than what you were looking at Tru Family?
Well, we got comfortable with that parachuting in eventually, and whereas now know what's around the corner, so can make someone aware either through data or experience on where to spend time, where to look. And I think that's we're looking at some stuff that I wouldn't call it distress, but they're underperforming, and I think not planning to run something, but know if needed can, and then bring something. Like it's really nice to be able to go into a space where you've got that opportunity. And look, if it's we buy something, and once again, is it working in the business or on the business? Well, we decide that, hey, we're going to go buy an asset that needs this, and this, and that doesn't make sense for our partners, our like the people we're working with, to go spend time there. All right, we'll go do that. And it's got, all right, we expect it to be a month, but we're human nature is we always under budget how long something's going to be. So, all right, am I comfortable with a 3-month stint? full time, yeah, let's go do that.
And if we're having this conversation 7 years from now, what would success look like to you when it comes to the two new ventures?
The success is always like, I think those around customers, team members, just like making, like, want to leave the world a better place. And like, okay, that's great, Brandon. What does that mean? Well, if we're helping our team members increase what they thought was possible, and meaning, we were very big on education and training within the organization. Like, we wanted people to continue to achieve more and push them, but then also help them, like, wanted to make the impossible possible for them. And so I look at that on a team member side, and then on a customer side. I mentioned earlier, who wouldn't want to be part of an organization whose hopes and dreams are to make this a positive experience to go to the dental practice. So I obviously want the performance from a shareholder perspective for both ventures. But I think that if these are such service oriented type businesses, and the culture piece matters so much. Whereas if we're truly making the world a better place within that organization, the financial results will follow thereafter.
Brandon, we've covered a lot. We've covered business school. We've covered Tru Family. We've covered your two new ventures. We'll close with the question that we always ask our guests, which is, what is the most underappreciated aspect of the investment opportunity associated with, I guess, what are putting together groups of what are essentially white collar service organizations?
I think I was just talking culture, and I think that's of course, when you look at one of these service businesses and a roll up, of course it's going to make financial sense. Like, if there's going to be scale opportunity on the cost side, hopefully you can drive revenue increase, and then the larger asset's going to be more recurring-esque or more protectable, and have so it's going to be worth more, right, from a multiple expansion opportunity. But what I think that gets underestimated is that cultural piece. Like, every day your revenue creators walk out the door, and they obviously have a incentive from a paycheck income perspective, but what else are you doing that makes this the best place in getting dispergent individuals to buy into a common goal? And it's just that cultural piece, especially in a roll up, where people didn't decide to work for you, they decided to work for someone else whom you've purchased, and really making that be a greater opportunity for them.
Well, Brandon, for someone who's spent most of his life, flying at 18,000 feet, or even, getting as low as 10,000 feet as a public company investor, I was really interested to hear about, like, what it's like to be an operator and an entrepreneur within the kind of a roll up. So this has been really fascinating for me. Really, really appreciate you being on Compounders.
Yeah, absolutely. Thanks so much for having me, Ben. Really appreciate the time.